Now that we covered all of the methods that do not use the time value of money, we're going to start talking about the methods that do use the time value of money or do account for the time value of money. The first method that I'll cover is the discounted payback period. And the reason I'll use it is then we can kind of compare it to the payback period. Okay. The discounted payback period is simply how many years it takes back to pay back our investment costs. Okay. But in this case, we're going to account for the time value of money. So it's exactly the same thing as the payback period, but accounting for the time value of money. So obviously, the first positive point for this method is that it does account for the time value of money. Just like the payback period, however, it does ignore all of the cash flows after the payback period. So again, if we had a huge positive cash flow right after the payback period, it would not consider that cash flow. It is also useful for firms with significant liquidity constraint. And also, in this case, there is an objective decision rule. And I know we didn't talk about the NPV yet, but basically, when a project has an NPV that is bigger than zero, if the NPV is $50, it means that the project will generate in today's value $50 of profit for the firm. If the NPV is 5,000, it means the project will generate in today's value $5,000 of profit for the firm. So basically, when the NPV of a project is positive, we should undertake this project. And when the NPV of a project is negative, we should not undertake this project because we're destroying value for the firm. The good news, okay, is that with the discounted payback period, okay, if the NPV is positive, okay, the project will have a discounted period. So if there is a discounted period, payback period, you know that the NPV is positive. So we should probably undertake the project. If the project does not have a discounted payback period, if the project in discounted term never pays itself back, then the NPV is negative. We shouldn't undertake the project. Okay. So basically, this is an objective decision rule, right? We can do the project if there's a discounted payback period, and we don't do the project if there's no discounted payback period. Okay. Um, and this is what I say here. The reason I much prefer the discounted payback period over the payback period is that with this method, you'll never accept a project with a negative NPV, because if a project doesn't pay itself back, you should never do that project, right? So if this the second case here is what happens in the real world, then obviously we shouldn't undertake that project. In the next video, I will do this example here.